Welcome to today's deep dive. We are getting into something today that, well, honestly, it drives a lot of people completely crazy.
Oh, absolutely. It is a massive psychological trap.
Right. So over the last year, the KSE 100 index, which is a major benchmark for the Pakistan Stock Exchange, it went up a massive 27.43%.
Which is a huge gain by any standard, really.
It is.
Hmm.
So here's a question for you. With the market up nearly 30%, why did so many day traders lose their shirts, lose their savings, and just generally lose their minds during that exact same 12-month period?
Yeah, it sounds impossible, but it happens constantly. And the answer usually comes down to one fundamental mistake. They were just staring at the wrong time frame.
Exactly. And people assume a rising market means this smooth upward line. But the reality is that markets are built on millions of individual human decisions.
Right, driven by fear, by greed, and just this endless stream of real-time information. When you look at the raw data coming out of a stock exchange, you are not looking at a smooth mathematical curve.
No, definitely not.
You are looking at a messy psychological tug of war.
And deciphering that tug of war is our mission for you today. We actually have a stack of real-time trading charts straight from the PSX.
Some really great examples in this stack, too.
For sure. We are going to look closely at the broad KSE 100 index first, and then dive into several major specific companies.
Because the goal here is to demystify technical stock analysis. You really don't need a finance degree to read the market's mood.
No, you don't. We are going to decode how these charts work, compare short-term noise to long-term trends, and really outline a daily visual routine you can use to manage risk.
Which is so critical.
So critical.
Okay.
Let's start with that initial paradox I mentioned. In our sources, we have two very different views of the exact same index, the KSE 100.
Yeah, the first one is a one-year summary line chart.
Right, and that one-year line chart, it's the macro story. It is the view from 30,000 feet.
Exactly. When you look at the line starting on the left side of the screen 12 months ago and ending on the right side today, it is undeniably moving higher.
It tells you that, broadly speaking, the environment is positive. The companies making up this index have grown in aggregate value.
But then, we pulled the second chart. It tracks the exact same KSE 100 index, but instead of a one-year line, it is a 4-hour candlestick chart.
And zooming in like that, it just changes the entire emotional texture of the data.
It really does.
We suddenly see this sharp drop from a high of over 170,370, plunging all the way down into the 176,000 range.
Yeah, it hit a low of 176,062.
Looking only at this 4-hour chart, it feels like the sky is falling. It looks like a disaster.
Totally. Which is why we need to break down the mechanics of this chart for you, because it doesn't use a normal line.
Right. It uses what are called candles, these little floating vertical rectangles with thin lines poking out of the top and bottom.
Yeah, and a candle is simply a visual summary of a specific block of time. So on a 4-hour chart, each candle represents exactly 4 hours of trading activity.
Okay, so the color of the rectangle, the body of the candle, what does that tell us?
It tells you who won the battle during those 4 hours. If it is green, the buyers won. The price closed higher than it opened.
Makes sense. And if it's red?
If it is red, the sellers won and the price closed lower.
Right. That part feels intuitive enough. Green means up, red means down. But I want to talk about those thin lines sticking out of the rectangles.
The wicks.
Yes, the wicks. Because our sources show some charts with massive wicks.
Oh, the wicks are actually where the deepest strategic insights lie. It's not just extra noise.
How so?
Well, the top of the upper wick shows the absolute highest price reached during that 4-hour window, and the bottom wick shows the absolute lowest price.
Okay.
So if you see a green candle with a very long wick stretching out of the bottom, it tells you a story of rejection.
Rejection, like the market rejected the lower price.
Exactly. It means at some point during those 4 hours, the price drops significantly, panic probably set in, but then buyers, often large institutional buyers who know a bargain when they see it, they just flood it in.
They bought up all the available shares and pushed the price right back up before the 4-hour window closed.
Spot on.
It is essentially a footprint. The long bottom wick shows you exactly where the big money decided a stock was just too cheap to ignore.
And, a long upper wick on a red candle shows the exact opposite.
Right. It shows a stock tried to climb higher, but hit this wall of aggressive selling pressure that pushed it back down.
Exactly. The wicks basically tell you where the boundaries of the battle are being drawn.
It's funny. Looking at the one-year line chart, is like reading the back cover summary of a book, right?
Hmm.
It tells you the hero wins.
I love that analogy.
But the 4-hour candlestick chart is like reading the actual chapters. You see all the terrifying moments where the hero almost dies.
That is exactly what it is.
Yeah.
And understanding that battle helps explain why looking at a 4-hour chart in isolation is so dangerous.
Because a single 4-hour red candle dropping 2,000 points feels like a total catastrophe. Your brain is literally screaming at you.
But crossing that data with the 1-year line chart injects immediate necessary context.
Right, you see the 4-hour drop, you cross-reference the 1-year trend, and the panic just kind of neutralizes.
You realize this is not some historic crash. It is just a minor pullback within a dominant 27% upward trend.
And this simple act of checking multiple timeframes is really the foundational habit of risk management. It prevents you from making permanent decisions based on temporary volatility.
Which sets us up perfectly to look at how these individual candles string together over time, because one candle is just a single 4-hour skirmish.
But a string of 50 candles reveals a trend. Let's move from the broad KSE 100 index to look at specific companies.
Good idea.
We have 4-hour charts here for Interloop Ltd, Pakistan State Oil, Pakistan Telecommunication, and Gandhara Tire and Rubber.
ILP, PSO, PTC, and G2IR.
Right. And there is a shared visual feature across all 4 of these charts. Someone has actually overlaid these blue shaded diagonal pathways onto the candles. They look like tilted hallways.
Yeah, those pathways are called channels. They represent an established short-term trend.
Okay, so how do they work in practice?
Well, the price of PSO, for instance, isn't going up in a straight vertical line. It breathes.
Yeah, zigs and zags.
Exactly. The green and red candles zigzag up and down, but they remain safely contained between the upper and lower parallel lines of that blue channel.
Yeah, PSO is currently sitting around 346.95, and you can see it just bouncing rhythmically off the bottom blue line and back up toward the top blue line as it marches upward.
It is very systematic.
But what is actually causing the stock to behave this predictably? Like, why do channels form at all?
It is because of the rhythm of institutional buying and selling programs. Large funds, they do not buy all their shares at once.
Right, because doing so would spike the price too fast and just ruin their own entry point.
Exactly. So they buy a little, the price rises to the top of the channel, and then they pause.
And then day traders take some profit, pushing the price back down to the bottom of the channel.
Right. And once it hits the bottom, the institutions buy a little more. This algorithmic rhythm is what creates those perfectly parallel lines.
It's crazy how visual human behavior can be. So are these channels basically like the bumpers at a bowling alley?
Bumpers at a bowling alley?
Yeah, like the stock is the bowling ball bouncing back and forth, and as long as it stays in the lane, the trend is safe.
That is actually a perfect analogy, yeah.
But what happens when the ball jumps over the bumper? Because we look at the charts for TPL Court and TPL properties, and the visual geometry completely changes.
Oh, totally. Instead of tilted blue hallways, those charts are dominated by harsh horizontal red lines.
Right, horizontal, not diagonal.
Those horizontal lines represent the concepts of support and resistance. Think of them as the psychological floor and ceiling of a room.
Okay, so on the TPL Corp chart, the price candles keep dropping down to roughly the 10.90 mark, stopping and bouncing back up.
That is the floor, the support line.
Then they climb up to around the 18.24 mark, hit their heads, and fall back down.
And that is the ceiling, the resistance line. TPL is actually trapped right near the top of that room right now, hovering around the 17.65 to 18.14 area.
So I understand the analogy of a floor and a ceiling, but let's dig into the human behavior driving this. Why does a ceiling form at 18.24? Why does the stock magically stop there every single time?
Well, it has to do with an incredibly common human emotion, the desire to simply break even.
Break even.
Yeah. Imagine a trader bought TPL at 18.24 a few months ago, right at the top of a peak. Almost immediately, the stock drops.
Oh, that is the worst feeling.
It is. That trader is stuck holding a losing investment, feeling the pain of that red number in their portfolio every single day.
So they tell themselves, if this stock ever gets back to my original purchase price, I am selling immediately just to get my money back.
Exactly. So when the price finally climbs back up to 18.24, there's a massive wall of people doing exactly that.
And they all hit the sell button at the exact same moment.
It creates a huge wave of what we call overhead supply. The sudden influx of sell orders overwhelms the buyers, and the price is forced back down.
That is the actual mechanism behind a resistance line. It's just people wanting out.
Right. And the inverse is true for the support floor.
People who watched the stock bounce off 10.90s previously are waiting for it to drop back down to that level so they can buy in at what they perceive to be the absolute best bargain.
You've got it.
Wait, but if the resistance line at 18.24 is universally visible on everyone's chart, doesn't it become like a self-fulfilling prophecy?
How do you mean?
If I know a massive wall of sellers is waiting at 18.24, I'm going to sell my shares at 18.20 just to beat them to the punch.
Ah, right.
And the guy next to me realizes that, so he sells at 18.15.
Well, you have just described exactly how market liquidity works and why resistance lines often become thicker and harder to break the more times they are tested.
So the anticipation of the ceiling actually reinforces the ceiling. But ceilings do break eventually. I mean, let's look at the chart for TPL Properties. It has horizontal red lines, just like TPL Corp, but instead of being trapped in one room, it looks like a staircase.
Right. It spent time bouncing on a floor near 11.04, and then it broke straight through the ceiling.
And now it is stepping up toward a new ceiling in the 13.40 range. So what causes that ceiling to shatter?
A breakout happens when a catalyst, perhaps an unexpected earnings report, a new product launch, or a shift in the macroeconomic environment, it brings a surge of new, aggressive buyers into the market.
So their desire to own the stock is so intense that they simply buy up every single share the break-even sellers are trying to dump at the resistance line.
Exactly. The overhead supply gets completely absorbed, and once those sellers are flushed out, there is nothing left holding the price down.
And the stock just surges upward into new territory. That makes perfect sense. The fundamental rules of supply and demand briefly overwhelm the established psychological boundaries. So how does a trader actually use these channels and horizontal lines to build a daily risk management habit?
A disciplined trader uses these lines to eliminate guesswork and limit their exposure to loss. You do not buy a stock just because it feels right on a Tuesday morning.
Right, you wait.
You wait patiently for the price to drop down and touch the support floor or the bottom band of a blue channel. That becomes your entry point.
Because history shows the stock has a high probability of bouncing back up from that exact line, meaning your downside risk is historically low.
Exactly. And when it comes to selling, you don't hold on forever hoping the stock goes to the moon.
You sell when it approaches the resistance ceiling or the top of the channel because you understand the psychological wall of sellers waiting there.
You take your profit and step away before the bounce back down. It forces you to buy low and sell high based on visual evidence rather than emotional whims.
But the strategy fundamentally shifts when a breakout occurs, right?
Right. When a stock jumps over the ceiling or crashes through the floor, which we call a breakdown, the old boundaries are suspended.
The stock enters a state of high volatility, driven by a sudden surge of intense greed or intense fear.
And we see that intense volatility perfectly illustrated in our next chart. We have the 4-hour chart for Gandhara Automobiles Limited, ticker symbol GAL.
Oh, wow. And it is a stark contrast to the steady, predictable blue channels we saw with PSO.
The GAL chart shows what happens when momentum takes complete control.
It doesn't have a neat channel at all. It is characterized by these massive, extreme vertical price spikes. The green candles shoot straight up near the 600 mark.
Yeah, hitting absolute highs around 594.
And then, almost immediately, there are equally massive red candles crashing back down. It is currently sitting at 572.51, but the journey up and down looks incredibly violent.
If you were trading this based purely on drawing floor and ceiling lines, the sheer size of these swings would completely wreck your strategy.
Which brings us to the built-in tools traders use when price action alone is just not enough to make a safe decision.
The indicators.
Right. If you look at the bottom of the GAL chart, and this holds true for all the charts in our sources, actually, there is a separate section with squiggly lines tracking beneath the main price candles.
These are your momentum indicators. The sources specifically show the RSI, the relative strength index, and the stock RSI, the stochastic RSI.
I promised we would avoid terrifying financial jargon, so let's translate this. What is the relative strength index actually measuring?
Do not let the terminology intimidate you. The RSI operates on a simple scale from 0 to 100. It is measuring the raw speed and heat of the market's movement.
Okay.
Think of the price chart as a tally of what the stock is worth, while the RSI is a measure of how frantic the crowd is acting.
I mean, I like to compare the RSI to a car's tachometer.
Right? That makes sense.
Like, the price chart shows how fast the car is going, but the RSI tells you if the engine is, redlining and about to overheat.
Right.
So even if the price is climbing, the RSI might be screaming at you to pull back.
That is an excellent way to visualize it. Or like an auction room.
An auction room.
Yeah, the main price chart shows the dollar amount the auctioneer is calling out, but the RSI tells you how many people are screaming bids.
Oh, I like that. If the price is climbing, but the room is suddenly getting very quiet, the momentum is dropping, the auctioneer knows the bidding is about to end, even if the hammer hasn't fallen yet.
Exactly. When the RSI line shoots up high, typically above the 70 or 80 mark, the market considers the stock to be overbought.
Meaning, the buying momentum has reached an unsustainable fever pitch.
Too many people rushed in at once, the auction room is deafening, and statistically, a drop is imminent because those early buyers are going to start taking their profits.
And if you look closely at the GAL chart, you will see the peaks of those massive green price candles line up almost perfectly with the RSI spiking into that overbought territory.
And the reverse is also true. When the RSI line dips way down low, near 20 or 30, the stock is oversold.
The panic has peaked, the sellers have exhausted themselves, the auction room is empty, and a bounce back upward is highly probable.
The RSI gives you a reading on the crowd's exhaustion level.
Now, you also mentioned the stock RSI, the stochastic RSI, which is visible in the sources as well.
Yeah, this is a slightly more advanced tool, but it is crucial for navigating high volatility like we see with GAL.
What is the actual difference between the two? If the RSI is already measuring the momentum, what does the stochastic version do?
Well, the standard RSI measures the momentum of the price. The stock RSI measures the momentum of the RSI itself.
Wait, it's measuring the momentum of the momentum.
Exactly, it is a derivative. Because it is measuring a smaller, more concentrated data set, the stock RSI is hypersensitive. It reacts much faster than the standard RSI.
So it will signal an overbought or oversold condition earlier.
Right.
So if the RSI is the warning light on your dashboard, the stock RSI is like a warning light for your warning light.
Right.
It alerts you that momentum is shifting before the main RSI even registers the change.
Precisely.
But doesn't that hypersensitivity create a problem? If it reacts to every tiny fluctuation, doesn't it give you false signals?
That is the exact trade-off. The stock RSI will give you earlier entry and exit signals, but it will also generate more false alarms.
Because a hypersensitive tool in a highly volatile market can make you jump at shadows.
Yeah. That is why professional traders never use an indicator in isolation. The indicators are designed to be cross-referenced with the visual boundaries we discussed earlier.
Right, so let's actually put all these pieces together. We have covered time frames, candles, wicks, channels, support and resistance lines, and momentum indicators.
A lot of ground covered.
So how does a beginner synthesize this sheer volume of data into a practical, repeatable daily routine? You wake up, you open your trading platform, and then what?
You follow a systematic four-step process. Step 1 is establishing the macro context. You pull up the one-year line chart.
Are we generally in an upward flow, like the KSE 100's broad gain, or are we in a downward spiral?
Exactly. This sets your underlying bias for the day.
Step 1. Look at the forest before you look at the trees.
Step 2 is the micro action. You switch to your 4-hour candlestick chart to see what the market is doing right now.
You look at the color of the current candles and pay close attention to the wicks to see where institutional buyers and sellers are drawing lines in the sand.
Right. Then step 3 is drawing your boundaries. You look for the visual patterns.
Is the stock marching steadily upward within the diagonal blue lines of a channel, like PSO, or is it trapped in a horizontal room, bouncing between a support floor and a resistance ceiling, like TPL Corp?
You identify where the price is currently located relative to those boundaries.
And finally, step 4. Before you make any decision to hit the buy or sell button based on those boundaries, you check the market's heartbeat.
You look down at the RSI and the stock RSI to confirm the momentum.
So let's say your stock has just dropped down to touch the support floor. Your visual boundary tells you this is a good place to buy.
You look at the RSI, and it is sitting down at 25, deep in oversold territory. The crowd is exhausted.
The indicator confirms the boundary.
That is a strong, validated signal to execute a trade.
But if the stock touches the support floor and the RSI is still hovering at 60 or 70, meaning there is still plenty of downward momentum left in the room.
You step away. The indicator is warning you that the floor is likely going to break.
By combining the shape of the 4-hour candle, the location of the price within your drawn boundaries, and the temperature reading of the RSI, you protect yourself. You take the emotion entirely out of the equation.
It transforms what feels like gambling into a calculated statistical process. You are not trying to predict the future with absolute certainty.
You are simply stacking the probabilities heavily in your favor.
Technical analysis is the art of reading the market's current reality as clearly as possible. When you know exactly what the data is telling you, the fear of the unknown dissipates.
And that really brings us to the core of this deep dive. Reading candlestick charts from the Pakistan Stock Exchange or any exchange in the world is not some dark magic reserved for Wall Street insiders.
Not at all. It is a language.
It is a language. It is about understanding the 4-hour skirmishes between buyers and sellers, while having the discipline to keep the one-year trend in mind for perspective.
It is about recognizing human psychology mapped out in channels, support floors, and resistance ceilings to manage your downside risk.
And it is about checking the crowd's momentum with tools like the RSI before you commit your capital. By synthesizing these simple, logical steps, you can turn a screen full of chaotic, flashing data into a calm, systematic routine.
And a calm routine is the ultimate edge in any market environment.
I want to leave you with one final thought to mull over today as we wrap up. We spent a lot of time analyzing the illusion of time frames.
Yeah, we did.
We dissected how a single 4-hour red candle, just a momentary drop in price, can trigger widespread panic and make an investor feel like the entire market is crashing.
Even when the data says otherwise.
Yet, when we zoomed out to the one-year trend, we saw a massive, undeniable upward trajectory.
Yet, nearly 27%.
It makes you wonder, how much of our everyday anxiety, not just in managing a financial portfolio, but in our actual lives, our careers, our personal relationships, how much of it comes from simply zooming in too close on a negative present moment?
Oh, that is a great question.
We hyperfixate on the 4-hour red candle of a bad Tuesday or a difficult conversation, and we convince ourselves the sky is falling.
We completely lose sight of the macro trend.
Exactly. What if all we need to do to feel secure, to actually manage our own internal risk, is to consciously stop staring at the microdrama and just zoom out to recognize the upward channel of our own long-term progress?
Keep that perspective in mind the next time you feel like you are hitting a ceiling.
Thank you for joining us on this deep dive. We'll catch you next time.